Hey, folks, welcome to InTheMoneyStocks.com's intraday analysis video, brought to you by the creators of proprietary price, pattern, and time methodology. Learn the PPT strategies and profit for life. My name is Gareth Soloway, Chief Market Strategist here at InTheMoneyStocks.com. All right, folks, Wednesday, April 2nd, 2014 is the date. Markets are basically on the flat line. SPY here, which is the tracking ETF for the S&P, is up about 22 cents right now. You can see we just made a nice little in spirit of bearish pattern, and we're now starting to move lower off of that. Early in the day, we saw a little bit of a float up. Notice this little high and then this little double top around this resistance area. And ultimately on the second double top, you couldn't break through. Thus, the market has backed off, came down, kissed the 50 MA, consolidated into the 20 moving average, and now is starting to sell off just a little bit. Now, one thing I want to make clear, there's no volume in this market today, so it's not like this is a big move one way or the other. I think the volume fits the day, which is a flat day. If we look at the S&P 500, we're up 1.2 points on the day, so basically 1 point. Dow is up 6 points, and the Nasdaq's actually down 5.5 points. So that's where you get that flattish type day. You got the S&P and the Dow fractionally positive, with the Nasdaq fractionally negative. All right, a couple little things to go over. Number one, we saw a 3-day rally in the market Friday, Monday, and Tuesday. That's really the longer of the periods that we've seen lately, and that's what the market's been doing lately, folks. If I zoom out on this chart, I want to show you this. I think this is very interesting. All right, look at what the market's been doing here. It's been going down, up, down, up, down, up, and that's what we've been doing over and over again, and that's actually been going on since really January. And what does that tell us? Well, it tells us that the markets are resilient in terms of buying the dip. You got the average investor coming in, but then why does the market stall out as soon as it gets back to its highs or makes a brief new all-time high in the S&P 500? And the answer is simple. You have institutional selling. I mean, this is distribution. It's continuing to be distribution. Remember, we've had a rally in this market since 2009. It's a 5-year rally. So the distribution is going to be a longer period. All right, just like the money flow from the average investor is probably spread over a fair amount of time, the distribution is not going to be able to be done in 1 month, 1 week, 1 day. It's going to take multiple weeks, multiple months, and maybe even a full quarter plus. So we'll have to see again how this all plays out, but it is interesting to see the market, and again, I think it warrants a mentioning how the market seemed to move up and rally for a few days, get to kind of the all-time highs, right around those highs, and then they just start dipping again. We saw that last week, we saw that a couple weeks prior to that, and over again. So based on that analysis, my expectations are now actually in play that we should see some downside in this market. I think today is going to be a flat day. I think tomorrow most likely will be another flattish type day because we're waiting on the jobs report for Friday. But I would say by late Thursday, Friday into next week, you probably start seeing some selling pressure come in. And I think it's interesting too because if you look at certain stocks that were leaders yesterday, the Netflix, the Teslas, the price lines, those stocks are showing some weakness here. And if we go to like Netflix here, take a look. Netflix, yes, early in the day when the market was at its highs, and here when it was at its highs again, double top, Netflix was up on the day, but then quickly came in to go negative on the day here, down about $5. So we're seeing kind of that reemergence of a little bit of a weaker tech sector, and that's why the Nasdaq's down today, obviously. But I think that can be explained away excuse me, as people who want to not take risk, and they're moving out of the risk environment again, which tells us that the general sentiment, especially amongst the bigger players out there, is that we're going to be pulling back again very shortly. All right, couple other things to go over here. Let's go over gold. Gold is bouncing finally. It's actually making a nice consolidation pattern around the 200, which actually tells me we probably pop up again in the coming days. I've been expecting really all week to see a bounce in gold. Finally, we're getting it today. And again, we'll see if we can continue to add that Thursday into Friday. But if you go to the daily chart of gold, I'll show you here. All right, so gold, I thought it would bounce right around this necktie or just below. We came down here just shy of this little support. Now you're starting to get a bounce. But anytime you see a retrace, notice this up move, dramatic up move in this retrace, you're going to get some sort of bounce once this move's extended enough, just based on it being an inside bar move. Now it's up to us to kind of figure out where exactly it will. And I actually think the upside's pretty substantial. See this gap fill up here in the 20 MA? That's my guess, is when you do a bounce, you'll probably get back there. Then you'll start to fall again. And I think later this year, we actually could come down to these lows again, which will be a great opportunity if we go a little bit lower to actually pick up physical gold. And that's what I'm really looking to do, folks. If we could ever get this gold price down to about $1,000 per ounce, I'll be buying some physical gold as a hedge myself going forward. I want to have that physical metal. So we'll see. We'll see again how it plays out. Other interesting stocks on the day. Again, it's a pretty quiet day with only about 52 million traded on the spiders at this point. But just some interesting price action. We're seeing J.P. Morgan on the weaker side here. And yesterday, the stock was actually flat to lower as well, even with the market rally. So it's kind of an intriguing type of, what's going on here event. I mean, what is the reasoning behind the JPM trade being so weak? Is there some sort of outlying situation? Could this high frequency trading, rigged market type event be causing some of these issues where people are thinking the banks will take the brunt of this, investigations possibly into their practices? I mean, I guess it's possible, but it's something that I'm kind of curious to see how it plays out. I did a lot of talking in yesterday's video about whether or not the markets are truly rigged, and they are to the traders. Absolutely. Like when I'm day trading, there's no doubt about it that when I put in an order to buy and I hit the offer, oftentimes a split second as after I press that button, someone else will mysteriously buy those shares, and then if I want them, I'll have to pay up for it. Stuff like that absolutely does happen. In reality, the biggest scam is portrayed, and it's one that can be avoided by the average investor, is the emotion scam. That's where the institutions kind of push through their agenda and run the markets in one direction, to an exponential level. At which point they pass along to analysts to upgrade stocks, and then the media takes hold, and it kind of creates this chain reaction or domino effect that gets the individual investor kind of thinking, "Oh no, I'm late to the punch here. I got to buy at the highs or sell at the lows." And that's really, in my opinion, something that is the rigging of the markets. But it's something that can be avoided if you understand the game. And I'm big on the game, folks. The game is what you need to do, and it's just a mastery of the game. You master the game, you're going to be in a good position. Okay? So interesting little tidbits there. I did put out a new trade alert today, folks, and again, I'm not going to give it to you in this video since this is the free video, but I did give out a new trade alert. It is already in the money. We put out one yesterday, which is also in the money, and that's good to see across the board. Okay? What else do we want to take a look at here? Let's take a look at Baidu today. Baidu had a nice day yesterday. Today, notice this, guys. This is actually amazing. I love the charts that show like this, because what you can see here very, very clearly is the big down move we had on Baidu, which was humongous. This is from basically $190, $95 a share down to about $140. So you're talking about 20 plus to 25% decline in the stock. And then the bounce here, where did it go today? Right into the moving averages. And that's exactly, as a trader, where you'd expect, or as an investor who looks at charts, that's where you'd expect it to be. All right, that's where you'd expect it to run into resistance and start to pull back. If we look at Priceline, let's take a look at Priceline today. Look at Priceline. I mean, another beautiful chart. Rallied up after a huge sell-off. Where did it go today? To the 20 MA on the daily chart, and look at it pull back off of that. So these types of things, very important to understand and kind of gauge. I can't stress it enough how important it is, I think, at least to be on point with looking at the charts. And they will tell you, I mean, they will tell you with a 90% success rate where that stock's going to pause, pull back, go up, and so forth. Okay? All right, going back to the SPY, let's just take a gander here. By the way, the market again has the jobs data on Friday, so that's going to be a big event. By the way, look at the chart here. I think this is awesome. So here's the Spider's daily chart. I know a lot of trend lines on this chart, but that's not a big deal to me. You can still see the underlying charts here. But notice today's price action. This could be a doji, folks, which is a bearish sign. And notice how you haven't gotten above the Spider's high here. Now, you might say, well how come the S&P 500 is at highs and the spiders aren't? Well, that's because the spiders pay out the dividend, so it's reduced by that dividend amount following the dividend payout. We've actually, as traders and investors, found that the spiders is the more accurate chart because of that dividend payout. And you actually, this is why you get double top resistance right here. See this high right here? And look at how it went right up there and then backed off. So, believe it or not, a lot of people would say, oh, I want to use the main index. But the main index when it comes to short-term swing trading and investing and trading and day trading, it's actually not as good. You want to actually use the root ETF, which is the main tracker, not the doubles or the triples. Those are off because those have depreciation factors. But you want to follow the specific spiders for the S&P. For Russell, it would be IWM. For the Nasdaq, it would be Nasdaq 100, which would be QQQ. For the Dow, the DIA. Those will give you a better, believe it or not, chart setup to understand and trade appropriately. So just cool stuff like that, little tidbits, and you can see it kind of happening today perfectly with that little doji here forming. Be interesting to see where the chart ends today. And again, it's hard for me to imagine a down day tomorrow, or at least a big down day, unless something abnormal happens with Russia or something else. If that happens, then obviously we could be in major trouble in this market. But for the most part, I got to believe that all eyes are now on the jobs number on Friday. All right, this week we've had a lot of chatter from, Yellen. We had the ADP private sector number, which basically came out in line today, which was no big deal, and some other things as well. So that's where we stand. Again, let me just flip back to the intraday chart to wrap things up. Let's see if there's anything emerging. And right now, again, you had a little bit of a pullback, now a little bit of a bounce. Volume, look at this, 52 million on the day. That is peanuts, folks. I mean, this is just unbelievably light. In fact, all week, which is another scary sign because the volume's been so weak all week and so light all week, is that it just tells you that there's no big money behind buying the market. You don't see institutions loading the boat, in other words. All right. Have a great afternoon, great evening. As always, folks, come join us at InTheMoneyStocks.com. And again, beautiful stuff going on here. Great trading environment. Take the 7-day free trial here at InTheMoneyStocks.com. Take care.